Welcome to Big Mike Fun Podcast by Mike Zlotnik.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike Zlotnik, and today it is my pleasure and a privilege to welcome Ben Kahle. Hey, Ben.
Mike, great to see you. Hope all is well.
Yeah, great to see you too. Ben is a partner at Wellings Capital. I know his other half is Paul Moore. He's been a great guest on the podcast, close friend, and they are doing some great work in mobile home parks and self-storage. And I'm not sure what else you're doing nowadays, but welcome to the show.
Thanks for having me, Mike.
So what's new and exciting in your personal life, home, family, anything that's kind of warms your heart?
Well, my wife and I just celebrated 11 years of marriage.
Congratulations.
The 20th, so recently. And then we are also preparing for the birth of our second child. So we got married pretty young and decided to wait, and now we're getting into it. So we're a combination of very excited and also nervous about the transition from 1 to 2.
Well, I'll just tell you that it gets easier. Well, I guess a little harder on the second, but it gets easier afterwards. So,
okay. Well, I guess we got to keep going then.
Yeah, I mean, I have 4, so all I can tell you is that it gets easier after 2, but from 1 to 2, yeah, maybe a little more work.
A little more involved. Yeah, that's what I hear. I've heard different things. Some people are saying it's so much easier than 0 to 1, and other people are like, no, like 1 to 2 kind of like broke us. So we'll see. Our first is not yet 2, but he will be. So I don't know. We'll see how it goes.
It's a good small difference. So at least from that perspective, you're not going to have a big difference in age. All right, let's get back to business. So what are you guys up to? What's kind of new and exciting right now at Wellings? Are you looking at storage, looking at mobile home parks and manufactured housing communities? Are you doing anything else? Just curious, you still sticking with the pref equity play for the most part, or what else are you doing?
Well, just for context, so Wellings is a real estate private equity firm, and we partner with operators or sponsors or GPs to come alongside them, and we're coming in as a joint venture partner, not as an LP. So we have control, and we're not just kind of along for the ride. We used to do that. And so I think from when we started, Paul and I, in 2019 to today, I think we've raised somewhere around $230 million of investor equity. And then with leverage, that's around $500 million of asset value approximately. Most of that is mobile home parks, self-storage, and then multifamily. Now, I think we've shifted away from some of the preferred equity stuff. I think there's been so much capital flowing into the preferred equity space the last, 12 months or so, that we've really seen coupon rates come down. The lending environment has changed as well, and that's probably also led to the lower coupon rates that we're seeing. So I think, for just as an example, like the probably market, and you probably see this too, Mike, with what you're doing, but I'd be curious your thoughts. But let's just use multifamily because most people know it. For say a 1990s or newer multifamily acquisition with a pretty good sponsor, decent tenure, good track record, you're probably going to be looking at like an 11 or 12% coupon, maybe like a 5 to 6% current pay on that. That's probably market.
On the
maybe a point in, a point out. Yeah, for pref equity.
That's total return. It's almost like at that level, you might as well do first lien debt. It's kind of like...
Yeah, exactly. And people are going up to 80, 85% loan to cost for their detachment point. So we haven't been competitive on any of those sorts of deals. We just don't think the risk adjusted return is there. So, we're open to doing more pref. And I think I'll caveat what I just said. I think if you're going to be in the smaller check sizes, like 5 million or below, maybe that $3 million range, the coupon rates do go up. So generally, there's more competition for 5 million, and then even more competition, 10 million check sizes and above, just because the
Let's
bigger shop has to
institutional,
deploy.
right? Yeah. So if you go into the institutional space where you're picking up even larger, even more than 10, if you go
Yeah,
20 and over, there's a lot more institutional money. But
correct.
really lower end of the mid market where 3-5 million, you have less competition. It's just you don't have the same big players. It's that they're too small for them. So as a
Correct.
result, you could ask for probably mid teens or closer to mid teens versus 11, 12.
Correct. And if you go down a little bit on the sponsor quality, if you go down a little bit on the asset quality, if you go down a little bit on the market quality, generally the coupon rate's going to go up too. So more risk, higher return generally. And we're in the $4 to $10 million check range per deal. And that's for pref and the JV equity we're doing. So we're trying to stay below where a lot of the competition is. I actually have a deal under term sheet with a sponsor we've invested with previously. And, they know us, we know them. And, the coupon rate's going to be a little higher than that 11 and 12% range because of that relationship. They know we can close. So you can find outlier situations, but I think generally coupon rates have come down, and most of the stuff we're looking at would be just straight like JV common equity or something we call JV hybrid equity, which is kind of a blend between common equity and pref.
So let's explore that a little bit more. So pref equity is when you're passive, but you pick the right horse or the right jockey, I guess both, and you're trying to mitigate your risk that way. So these JV equity deals, what asset classes again? Is it still mobile home parks? And are you becoming a co-manager, or they are still active managers, but you have some kind of control provisions, in case they don't do what they're supposed to?
So to the first part of your question, we are currently looking at mobile home parks, multifamily, industrial, and open air shopping centers or retail. That's it right now.
What happened to storage? Why you're kind of pausing the storage?
Yeah, we have a lot of storage. We still think it's pretty good. The stuff we have is thankfully doing well, and it's in mostly smaller secondary, tertiary markets where the REITs and bigger players have not been building. We just think storage does not have the same long-term outlook as some of these other asset types. Like, it's generally very easy to build storage. It's pretty easy to get zoning in a lot of places. There's exceptions, but it's just a commodity, probably more so than like multifamily, I would say.
Yeah, I hear you. Yeah, the fact that you're not protected on supply side is a huge factor. The
Yeah.
risks can multiply. Yeah. Okay.
Yeah.
Let's go back to obviously industrial. We love industrial, and then retail, love retail, and you said also manufactured home communities and
Multifamily.
multifamily.
Yeah.
So, what kind of deals are you finding? Are you finding deep value deals, or you're more of a, you need a super high quality partner first and look at what they got?
Yeah. So you had mentioned kind of what's our structure and how are we investing, and that links in with the sponsor quality. So I'd say generally we're more sponsor focused than deal focused. Probably 60 to 70% of our due diligence is on the sponsor, their team, their track record, how they hire and fire, how they incentivize their team members, how they incentivize their asset management team members specifically, and then like even more so if they do in-house property management, how they incentivize the on-site or the actual property managers. And then the other 30 to 40% of the due diligence is on the property, the market, all the basic stuff. And I think that's the easy part, like for us as an equity provider, the numbers are easy. The data is easy. It's getting our heads wrapped around the people that is the tricky part. I wish people were easier to understand, but we're all very complicated and we all have different motivations. We all have different values. And we're trying to figure that out the best we can in a 30 to 90 day window before we invest. We're getting references. We're talking to brokers in the market that they don't refer us to, and we're talking to other investors that we know and trying to get as many data points third party, not from the sponsor themselves, to try to understand who they are. So that's kind of that. And then we're coming in with
Can I ask you? Can
yeah
I ask you one question?
yeah
Are you trying to apply same methodology as in hiring? In other words, if you're looking for a partner, the good old, when I was in the corporate world, people hired based on skills, just not on, disc profile or some other personality in trends. Are you trying to just evaluate the principles of who you're investing with on their character and their values? And it is hard to do it. It is hard to do. It's almost, in a short amount of time, you don't have enough time to interact.
exactly. And that's why those third party data sources from other people who have dealt with them for years, hopefully, who don't have a dog in the fight, who can give us a real unbiased point of view, is so essential. Like, I was listening to this podcast with a former US Secret Service member, and she was saying that in her interview process, they sent agents to Italy, where she had studied abroad for a semester back in college. And they went to Italy and they asked her professor what she was like as a student. So we're not doing that level of due diligence on the sponsors we're investing with, but there's ways out there to get a feel for who people are and try to get a picture. And yes, like, we are definitely trying to understand their values. Like, you could have, like, say you could have the most skilled person in the world. Like, they're the best in the world at value add shopping centers. But if they don't have integrity, what does it matter if you're an investor? Like, the skill is irrelevant at that point, because they could be doing sketchy stuff with the money, or not being transparent about what's actually happening. I don't know. There's any number of things. So we're trying to understand their integrity level. If they'll lie about something in due diligence, which we've seen happen, they're going to lie later on. Like, we're getting married to these people basically for like 5 to 10 years. And it's possible to divorce, but it's very messy to divorce. And we can remove the managers or remove the operators in certain circumstances, depending on the lender. Usually we can, we control the budget. We'll hold back CapEx dollars. We can force sales. We get involved if we need to on the business plan. We do a lot of ongoing site visits, but we don't want to run the property. That's not our business model.
Yeah. It's who before how, right? If you can figure out the who first, because like you said, everything else matters less. If they're shysters or idiots, right? That's it. That's it. Doesn't matter what they can screw up a good deal. And
Yes.
yeah, I hear you. And then quite often, many years ago, I studied martial arts, and martial arts instructor said, in order to know somebody, you have to know them for 3 years or longer. And this is the Eastern philosophy. And you're trying to, if you work with somebody for that long, at that point you have a track record, and you know more or less who you're dealing with. But any new sponsor, even a referral, you're trying to make a 90-day decision, and real estate moves slow. And you're right, it's a luck. You luck for many years, and hopefully it's a good luck.
Yeah. If we try to just, I don't think anyone's going to get it 100% right 100% of the time in any type of investing, but we're trying to do what we can control to flesh out as much as possible before we actually invest.
Yeah, it's a good philosophy. So philosophically, it makes a lot of sense. At the end of the day, it's execution, like how well you could actually do it. And
Yes.
I've seen some people are really, really good salespeople, and
Yeah.
they everything looks just good and clean, and ultimately you won't know until a while from there. And also, sometimes you can only see it when there are problems. It's kind of risks are hidden. Some risks are hidden until there are problems, and certain type of problems. It's the good old
100%.
example when a house is built for earthquake on Richter scale 7.5, and it's all good until an 8 hits, right? Or 7.6 hits.
Yes.
It's kind of funny how it functions.
Yes, it's true. Yeah, the hardships reveal who people are more than any kind of successes typically. And we've seen that the last 2, 3, 4 years in the commercial real estate space, haven't we? It's been a tough couple years for a lot of groups. People have lost properties. There's been capital calls, and just if you just do some Googling, you're going to find all this sort of stuff just in general out there. And I mean, one of the things we do, if someone is listening today and they're considering investing in commercial real estate passively or even actively, it's like who you're working with. So it's like, one simple question of many that you could ask is like, so tell me, what's a recent mistake you've made and what did you learn from it? And then, but you want to go in already knowing some of the mistakes they've made. So you can vet them for how honest they are, how transparent they are, which one they tell you about, and just kind of gauge how they answer, because that'll tell you a decent amount about what kind of person they are.
Yeah, that's a great example. You're asking about if they've lost money or losing money, and interestingly enough, a while back, I had a call with the multifamily group, and they're pretty big name in the industry. And as part of the call, they claim they've not lost any investor money. And when I heard this, is like, how is this physically possible if you've been investing in multifamily in 21, 22? Now, the fact that maybe nothing has been foreclosed on, or they brought in a lot of their own money to kind of keep these properties, but it's the investor money is effectively upside down. The equity capital is already upside down, and if you're telling investors you haven't lost money, that is dishonesty. That's not a open conversation.
Yes.
And yeah, so on this topic, if you are new to the industry, you don't have a problem, right? Because you're new, you haven't done deals at the peak of the market, or if you bought really long time ago, and then you bought so low. But anyone from probably 2020 to 22, and maybe even 23, most likely have some level of issues. So that's the honest truth, and it's not on every deal, on every property, and some deals held up well, much better than others. Let's continue. What specific opportunities are you feeling they're most attractive today from a yield perspective? So cash flow
question.
being kind of goal number one, because there are opportunities where you could, have a good value add, but cash flow is cash flow. And
Yeah.
just curious, what are you seeing?
Yeah, it's interesting you asked that. So we actually have our first office deal under contract right now. It's supposed to
Office office
close.
or like flex office or some other
This is actually straight office. So I mentioned the asset types we're looking at earlier.
you didn't
This
mention
deal
office.
office was not in that list, but we got introduced to this group who's been doing office exclusively since the 90s, actually, and very seasoned professional group. Team members have been there 15, 20 years. And I think of all the real estate asset types out there right now, office is the number one risk adjusted return play today. I
You're
think that's
buying
going to change. What's that?
because you're buying so deep.
Yeah, at some point, if it's a well located, high quality property that doesn't have a bunch of, or it doesn't have like huge spaces, because I think when you get into like these 1 or 2 or 3 or 4 tenant buildings, that's tough right now. That's just going to be tough for a while. But if it's smaller suites and it's well located, I think it's going to be hard to mess up because of the basis and just like what's going on right now. So like we all know, office has
Kind of
been
cap
kind of hated and unloved. Rate going in on this is about 11%,
There you go.
and market cap, according to CoStar and some recent comms, as well as brokers who don't have skin in the game on this deal, because that's important. Don't ask the brokers involved what the cap rate should be. 8.5 probably for this particular market, maybe 8.75. So, and this sponsor actually owned this deal in a previous cycle. So they know it really well and they're buying it back very cheaply. So, the going in or the year one cash flow will be, it's projected just based on the in place NOI to be double digits, which is quite rare. You're not going to really find too many multifamily deals or mobile home park deals today that have that.
Yeah, it's impossible. But if you have unlevered 11% and you add any leverage, it can only get magnified. I'm surprised it's not even cash flow towards the teens at 11 with even 60% leverage at, I don't even know, 6.5, 7. I don't even know what the debt. I'm just curious what kind of debt.
Yeah. It's a 5-year fixed and it's not locked yet. It's going to be based off the 5-year treasury, when it gets a little closer.
Well, what's the
Plus-
risk premium? That's
plus-
what I'm asking.
Plus 250.
Yeah, so you are close to 7, right? Probably.
Yeah. Probably. We'll see what happens with the 5-year, but yeah. So I think we're going outside of our norm because of the sponsor quality, because of the location, because of the asset quality. I was there a couple weeks ago with Troy, our managing director of investments, for the site visit, and we walked every suite vacant and occupied. It's about high 70s occupancy right now.
High 70. You said these are small office suites. Like how many square feet each?
About
suite?
100,000 rentable square feet. And
But is it broken into a whole bunch of smaller?
yeah,
Like, are they 3,000 square feet?
it's all over the board. So there's 6 stories. There's one large tenant who has 1 floor, and they've been in there for over 20 years. And then there's other suites ranging from 1,500 to, I'd say, 10,000, just kind of all over the board.
And just a quick question: is the building functionally not obsolete? Because
It's well maintained. Yeah, this is not a dumpy building. This is probably like you walk in and it's nice. It's well maintained. It was professionally owned, and ran, but the previous owner has it in a fund, and they haven't. And why it's at that occupancy level is because they ran out of money to do TI, and they don't have any money for leasing commissions either. So it's not that our understanding is that there's not a market issue. It's a capital issue.
yeah, understood. So that's actually interesting. How you're picking up, you're going outside of your traditional box to find maximum yield, and office is a great example. 11% cap rate with occupancy 70, mid 70s. Right, that's what I heard. It's remarkable, right? You have a lot of upside if you can just make progress. And
Yes.
what market is there? What city? Just at least.
Yeah, it's in the Atlanta metro area.
Yeah, it's just still vibrant. A vibrant, good big city. But interesting how you see opportunity where be greedy when I was fearful, be fearful when I was greedy. Just you're finding great yield where others just COVID scared everybody. Are you finding anything interesting? Mobile home parks? Are you still seeing? Or is it slow? It's just
We'd love to do more mobile home parks. We really would. Deal flow has been pretty light, I'd say, the last 12 months compared to previous. The last couple weeks, we've seen more. We're getting probably 20-ish deals a week from different sources, capital advisors, sponsors we know, brokers, and there's some interesting mobile home park deals we're seeing for sure. But I just think because there's so much capital chasing mobile home parks right now, the returns have come down. Like things are getting bid up, and it's just going to the lowest cost of capital sponsors. Like we're seeing very few deals north of a 15 IRR that are like pretty typically structured deals, like 5-year deals. There's outliers for sure, but then you're going to be, sacrificing on market. You're going to be sacrificing on park-owned homes versus tenant-owned homes. You're going to be sacrificing on private versus public utility. you're going to be sacrificing on something to get above that threshold, I would say. So yeah, what about you? Have you been seeing any interesting mobile home park deals?
We are looking at some opportunities. We haven't pulled the trigger, but I hope to do something second half of the year. I think the innovation we'd like to do is find, a great sponsor and find a very solid deal and just break up the cap stack into preferred common units and high cash flow, low depreciation, high cash flow. Sorry, said the same.
Yes,
But
I know what you're saying. Mobile home
high
parks
cash
are
flow, low depreciation, preferred units and common units, high depreciation, low cash flow. And these things usually have a fast path to refi. And so it's, as long as that can be executed pretty well, it can work really well. And this technique can actually bifurcate benefits because people who really want to get a yield, but they can't in mobile home parks by being in pref. I mean, I'll give you an example. You can take a deal with 5% yield, right? I'm just thinking out loud. And then you with light lever, and then you send 8% cash flow to Class A and 2% to Class B, right? But you remove depreciation 90-10 the other way around. So people who take the depreciation, they get no cash flow, but they don't care. That's kind of it's a different. You're solving for different need. The cash flow people, I mean, your IRA money, I couldn't care less for depreciation or money that just needs enough depreciation to shield cash flow. You're giving 10% of total. You're on a cost seg, you still shield multi-year because the cost seg is just so high on depreciation. And
yeah, it's crazy for mobile home parks. You wouldn't think that. We actually just had an investor get surprised when they got their K1 from a mobile home park deal we did last year. And he was like, why is this almost like a 90% loss on my invested amount? And he was like, I wouldn't think mobile home parks are that good, but I think, it's like what, 60 to 75% of a mobile home park is classified as infrastructure.
yeah, and you write off the whole thing. Yeah.
Which
it's
has
$1 million write-off.
Has like a 15-year life. And then, there's land.
It's everything but land. You could bonus depreciate. There's nothing else because it's all improvements, land improvements. There's nothing there. Like literally, you don't have big structures. You just don't. I had a podcast recording, I think yesterday or the day before yesterday, with a CPA who kind of explained to me exactly that. It's the 15-year schedule or less, like 7.5 is obviously full, and all land improvements, they're 15 years or less. And as a result, you're done. You just got to remove the value of land.
It's not uncommon to get depending on the leverage. If it's a higher leverage deal, you could get 2x your investment amount as a tax loss in the first year when you do a cost seg.
Can even do more. I ran the math, I think, depending on the deal, but if you take $10 million deal, just very simple math, just for sake of simplicity. $10 million, 60% leverage. You get $6 million bonus first year depreciation, right? $6 million, you have $4 million equity. That's a 1.5x, right? And if you take that $4 million of equity and you make $2 million preferred and $2 million common, and
right. If you bifurcate it, yeah.
If you bifurcate it, you're suddenly easily in the mid twos. I mean, it's approximate ratio. I mean, none of this is exact, but it's just so
yes, consult your CPA.
Yeah,
we are not CPAs.
Yeah. Any kind of final thoughts? How do folks reach out? Appreciate the sharing, a little bit of contrarian view. Love how you think about finding people you want to work with, and ultimately it's just finding the right people and then the right deals. And so
yeah, I mean, I think probably the best way to maybe follow along is LinkedIn. So if you just search my name, Benjamin Kahle in LinkedIn, I'm posting fairly regularly. You can reach out to me there if you have any questions, want to learn more about mobile home parks or anything like that. I mean, there's a ton of resources now. You can pretty much AI anything these days, but I'm happy to share insights too.
Ben, appreciate your wisdom. Thanks for coming on a podcast. And thanks for sharing. And good luck with the office. It's interesting. It's almost so good that I'd love to take a look too. This stuff is so cool. It's almost
Yeah.
a contrarian play. The question is, can you still sell it to investors? Investors are not freaking out. They actually beginning to see the value.
Yeah. I think the answer is yes. And I think there's a window right now. I know we're going to try to wrap this up, but I'll just say this. There's a window right now for office where the institutional capital has not come back in. They're still nervous. And there's some really, really amazing, unique deals. And it's probably like talking to these guys we were with, like it's probably going to be not that big a window. They didn't say exactly, but like a year, maybe. That's total ballpark where there's office still being out of favor, not a lot of investor demand, but deals that are really good. And it's like, can you get the capital lined up? So we'll see. And we'll see about this deal. I mean, it's not over. I don't know when this podcast will come out, but we're still in due diligence. So we'll see what happens.
Well, good luck, and yeah, I love your contrarian thinking. It's almost like your downside is so protected, unless again, unless people start vacating office and AI and robotics just take over everything. And
You have to make a bet that there's always, at least in the foreseeable future, 5 to 10 years, there's going to be a need, a demand, a desire for humans being in a space together working on business. That's the demand. That's what you have to bet on. And I think that's going to be there. We'll see.
we shall see. Thank you, Ben. Appreciate
All right.
you.
Thanks, Mike. Appreciate it.